Welcome to the True Commercial Real Estate Podcast, your ultimate investor resource for all things truly commercial. Whether you're interested in industrial, retail, medical office, storage, single tenant, or any other type of non-residential real estate investment, this is your podcast. Chad, just so you kind of know the flow, I think we told you a little bit about the flow of this. So we obviously do our introductions. We'll do our interview. They'll have some questions that the audience can ask as well. And then at the end, we always do some networking. You're more than welcome to stay around for that if you like to and just chat with people, get to know people. We want to respect your time. So you're more than welcome to drop off if you want to drop off as well. So with that being said, for those of you who don't know Chad's been an industrial real estate broker since 2005. He started building his own investment portfolio in 2014. He's given numerous interviews locally, nationally regarding the commercial real estate market and has had articles published in Forbes, Western Investor, and Real Estate Magazine. In addition to earning his SIOR and CCIM designations, Chad has a diploma in urban land economics and an MBA. Recently, he started a YouTube channel to share his passion and knowledge about industrial real estate. If I missed anything, Chad, please fill us in.
It always sounds better when you write your own introduction. Thanks so much, fellas. I really appreciate you inviting me on. And it sounds like you guys have an awesome group of investors all over North America. So I'm excited to be here.
Yeah, thank you. Really, really stoked you're here. Everybody else is as well. When we told everybody you were coming, they were all happy. So if you want, we're going to dive right in. Thank you for joining us again. We really appreciate you taking some time out of your day to chat with us and hopefully educate us. And we're stoked about it. So tell us a little bit about how you got started in the world of real estate and, where that's led you today.
Yeah. So as you mentioned, I got started in 2005. I started in residential in 2004, which sounds like a lot of people in here started in residential as well. So I had owned a couple properties when I was younger, and it seemed like a natural segue just to get into real estate. So residential was my first stop. I did that for about a year. And then in 2005, I switched over to the commercial brokerage, and I've been at the same company ever since. Along the way, I still have a couple residential properties, but in 2014, it was late 2014, I started investing in industrial real estate as well. So with a couple partners, we've got roughly 12 million in assets under management, which is about 75,000 square feet. Of 4 different buildings. And the biggest one is one we're about to actually do a full renovation on. So we're doing a full exterior facade on it. It's roughly a 25,000 square foot building, full exterior facade and a full interior renovation. So over the next 4 months or so, we're putting $1.5 million into it. So there's a lot of stress and a lot of anxiety that comes with a project of that scale. So I may be a little bit more stressed come this time 2 months from now.
Makes sense. Well, that's awesome. You'd mentioned, the residential side, but have you focused on any other areas outside of industrial? And if so, what kind of guided you towards industrial?
Yeah, so when I started at the commercial brokerage that I'm still at to this day, it was predominantly an industrial real estate office. Most of the guys just did industrial. So almost by accident, I stumbled into industrial real estate. When I first wanted to get into commercial, I had ideas of perhaps selling office buildings or big shopping centers. And as fate would have it, I now sell warehouses. So it's quite a bit different from what I first thought it would be, but it was more just because of the people that were in my office that I got into industrial 15, 16 years ago now. And I'm glad that I did. It's been a great career that I've had. It's become more of just a job for me. It's become an actual passion. Like I try to know everything I possibly can about industrial real estate, both because my job is directly tied to it, and then also because I've got the majority of my net worth tied directly to industrial real estate.
Yeah. You can tell when you watch your YouTube videos that you're passionate about it for sure. So along those lines, what is your favorite thing about industrial? What both investing in on the brokerage side, what's your favorite thing about industrial?
I'd say the thing that I think is most attractive about it is that it's a very steady asset class. And there's nothing that better exemplifies that than this past year that we went through, where I'm sure all across US and Canada is the same. Stores were forced to close down. Most office workers weren't even allowed to go in there. And that came with an accompanying huge downward pressure on those asset values. I think it's
Mhm.
normalized for the most part, but that was a huge roller coaster for office and retail over the last year. Whereas industrial was actually pretty steady. Like there might have been a small dip in the first month or two, but then it was actually pretty steady all the way through. So that last year has been a good example of how industrial just keeps trucking along. In
Yeah.
15 years that I've been doing this now, lease rates have only gone up. And I'm in a market that has heavy oil and gas exposure. And even with that downward pressure on oil and gas, our industrial market has still gone up. So I think it's a really steady asset class. It's not sexy. It's not in the news. People aren't dreaming of owning an industrial building when they grow up. But it's that steady, consistent driver of the economy. And as far as I can see, as I extrapolate out years or decades down the road, I think it's going to continue being a really good asset class to look at.
Yeah. Well, I think metal buildings are very sexy. So no. So that there's some great points there about the benefits of industrial. What would you say some of the downsides are? Maybe your least favorite part about the asset?
I think the least favorite part is the fact that it can also come with a lot of risk. Even though it's a very steady asset class, if someone doesn't fully understand what they're buying, there can be a huge discrepancy between a sophisticated investor and somebody that's new into it. So, and that's one of the reasons that you see a lot of institutional buyers and owners of industrial properties, because they are very sophisticated. Whereas a new investor or someone with a small portfolio can easily get burned.
Mm.
And we can talk about that more. But the biggest example that I could give is if you buy a property that perhaps it's a single tenant building that maybe has a lease coming up in a couple of years. If you don't fully understand what that investment is and what the tenant market is when that lease comes up for renewal, you could potentially get stuck with a building that's vacant for a considerable period of time. So I think the biggest risk is also the biggest opportunity. The biggest risk is that you can get stuck with an asset that underperforms, or you have a hard time disposing of or releasing. But that also gives an opportunity where if you understand exactly what you're buying, you can position that for future upside. So it's a two sides of the same coin: risk and reward.
Yeah, absolutely. Absolutely. So you had mentioned that in a little bit about the risk side of it, the upside of it. Do you have a primary investment strategy that you go after? I mean, are you going after properties that need that value add more? Are you looking at more core or core plus? What areas do you and your group look for?
Yeah, great question. I would say we're in between core and core plus. The two of the other properties that I have are long-term multi-tenant. We've got long-term leases on all of them. We've had a little bit of turnover over the years, but for the most part, it's just been releasing at market rates. The one that I mentioned at the beginning of the call, that one was kind of a core plus. We had a lot of vacancy when we bought it. We had about 8,000 square feet of vacancy, so almost 20% of the building was vacant. We had to do a considerable amount of work. We had an interior dock in the building, so we had to fill that. We had to do we've already spent 300 grand on that building. We've got another 1.5 million to go. So that's almost kind of a redevelopment in that way. That's probably the riskiest one that we've done, though. Everything else has been either long-term tenants or just that core value.
Yeah, it sounds like what you're saying is from the asset class, it's probably wise to have a little bit more money going into these properties, or at least do your due diligence in a lot more specific of a manner, because there are huge expenses. Ken was talking to us earlier in the day about when a roof pops up, it's not a small roof. It's not a residential roof. It can be very expensive. So, talk to us about that in your due diligence in the properties you target. Do you have a specific criteria you're looking for? Location, building size, ceiling heights, amenities? What do you guys have kind of that box that you buy in?
Yeah, great question. And before I answer that one, I'll just talk on the roof, because
Sure.
the roof is part of this project that we're doing. And we're seeing quotes anywhere from $15 to $17 a square foot in our market right now. So we're like, our quote for a roof replacement is 400 grand. So that's a sizable cost that most people just don't factor into it, like spending 400 grand. So that's a really key thing. The biggest thing that I look for is I want to fully understand what the property is, irrespective of who the tenant is. The tenant is great. You're buying cash flow for to some extent. If you're just looking at it from a pure capitalization standpoint, you're capitalizing the existing income. But I like to look at making sure my downside risk is protected. So I'm always going to look worst case scenario. If I did lose all the tenants, what is the market to lease that back up? What type of building it is? I think that's imperative. Probably the biggest thing that I'd say to new industrial investors is fully understand the subcategory of industrial, because you can have a manufacturing property or you can have a distribution company. They're both technically industrial, but they serve two completely different types of tenants. So I think you really need to know what type of property it is, and then also have a lot of comfort that the space can be leased at a rate commensurate to what your expectations are, or at least so you have a hedge on what your downside risk is. And the best analogy that I can give for it, and the reason that I don't do more speculative stuff or development stuff, is I kind of look at investments on a pendulum. On one side is your potential return that you can get on that investment, and then when it swings the other way, that's your potential downside risk. And there's too many investors, and I suspect some people on this call either know someone or potentially experience this themselves. They look at a property that might have, call it 30% downside risk. Maybe the tenant is coming up for renewal in the next year or two, and you're not sure what that lease renewal is going to be. But for whatever reason, you factored in that you might have a 30% downside, but they only look at like an 8 to 10% upside on that asset performing best case scenario. And that to me is a peculiar investment decision. If you're looking at a downside risk of 30%, I think you should be looking at an upside risk of 30%. And for me, my comfort zone on just where I've done well in my investments is I don't need to hit those home runs. I can hit singles and doubles, and with a long enough horizon, I've got a good 15-year horizon left in my portfolio. I don't need to hit a home run right out of the gate. I'd rather have minimal downside risk so I don't get caught off guard, and I'm comfortable hitting those singles and doubles, which is kind of commensurate to that other side of the pendulum equation.
Yeah. No, I like that. That's a great way to look at it. And I think you're right. I think, and sometimes I'll see people do that, or they'll do the opposite. They get rose colored glasses and they think that the upside is 50% and the downside's 5. And it's just
Yep.
all in, And so I agree 100%. You definitely have to weigh the risks and reward, and there is a risk. If you have a 100,000 square foot building that all of a sudden becomes empty, that now needs a roof, there's a good chance that if you're not well capitalized, you're going to have a hard time. So yeah, that's great advice, phenomenal advice there. Yeah, Aurelian, I think I'm gonna pass this off to you. Sorry, I've been doing all the talking here, so I'm gonna let you ask a few questions.
Thanks. Yeah, you spoke about core and core plus. Chad, could you define those concepts for our listeners?
Yeah, I think core, as I would define it, and I think that the terminology might vary market to market, but how I would define a core is a stabilized property. So you're buying something that already has existing cash flow. Maybe there's some rental escalations in there, but you know pretty much exactly what you're getting. Core plus would be one where lease rates might be under market. So perhaps the building needs some cosmetic work, or just it needs some work to it to get it to a point where you can get market rates. Those where I'd say core and core plus would be.
Mhm.
Thank you. And in terms of your investments, you've mentioned it en passant earlier. Do you have investors, or is it just your investments? Is it a mix of both? How do your investments look like?
Yeah, outside of two residential properties that I still own, I've got partners on everything. So the three of them, it's myself and between two and three close friends, and we're all equal equity partners. And then one of them, we did a GPLP model, so we actually raised outside money on that one. But even with that one, I still have an equity position in that one. So I've got a considerable amount of my skin in all of these.
And could you tell us, because we are all very interested in the term, in terms of financing and raising capital. Can you expand a little bit maybe on that capital raise?
Yeah, so the on the three that it's just myself and two other partners. One of them I have three other partners. Uh, those ones are just traditional financing. So we use big banks to go through them. We've got anywhere from 25 to 35% of our equity in there, and then the rest is just bank financed. So we were in a position to do those ones with really low interest rates. One of them we just came off a renewal. We had a 3-year fixed interest rate at 2.57. So that, and we did that purchase 2017, I believe. So we just get really good interest rates if we have a higher amount of equity into it. On the other one we still actually put down 35%, but we raised roughly $1 million to buy that one. And we did that one in a GP-LP model. So the GP partners are the ones responsible for the mortgage. And then all of our LP partners are basically just equity partners. It's a lot more complex from a legal standpoint because you have to set up a whole GP-LP model. They're all supposed to be accredited investors. So you've got to put a subscription in place. It's a lot more complex. And I don't know if I would do that one again, to be honest. It's a lot of work managing all those additional partners. I think we've got 7 or 8 LPs in that one. So it's just a lot more complex. Our legal costs of setting up that GPLP model was much more. We were pretty much an additional 20 grand in legal fees setting up that organizational structure at the beginning. And then we just have more accounting, we have more property management, just more accountability to that partnership in general. But with all of them, we were between 25 and 35% of equity into them.
Okay, and how did you find those LPs? How did you raise the equity?
Well, it's a good question because it was actually a lot easier than we expected. So where I say that it's hard setting it up and it was hard organizing and it's hard accounting for it, it was actually pretty easy to raise the capital. So when we started reaching out to investors, we just went to pools of guys that we know. So we've got a couple guys in finance in it. We've got a commercial appraiser who's a LP. We have a property manager who actually is the property manager for the building. So we've got a pretty diverse group of people in it. It's all people that we know quite well. So we were able to do it just by word of mouth. And part of that came because we had a track record of doing this ourselves. So when we did the raise and we raised about $1 million, we did it within about a week and a half. And we actually had to turn people away. We had people would tell their friends or other people in their office. The appraiser is a good example. He had 2 other appraisers in his office that wanted to come in, and we just oversold the subscription. So I think I make it sound like it was easy raising that money, but there was years and years of us building up to that credibility and then also doing it ourselves through trial and error. So I think it would have been a lot harder if we just tried to do that with no resume behind us.
Thank you. Yeah, you hear that a lot. A track record helps when you want to raise capital. So where do you invest in your backyard, or do you do that remotely? What are your thoughts on that?
I'm a big believer in investing in the market that you're in. I did a small project in Columbus, Ohio, actually, before I got in as an agent. Myself and a few friends did a small multifamily project in Columbus. This goes back to probably 2003 now. And we had a real hard time with it just because we weren't in the market. We didn't have boots on the ground, so we weren't intimately familiar with it. So that burned me a bit. So that's definitely biased my investing decision to be more focused on local. But I also think that there's a big advantage with investing local in the fact that you just know the market a lot better. I was talking to a guy in Nashville last week, and I was saying to him, if you wanted to invest in Chicago, for you to understand Chicago's market as well as you understand Nashville's would mean you'd have to spend a considerable amount of time learning Chicago's market. And you only have so much time. So that would mean that you'd understand Nashville's market that much less. So I think having that really deep knowledge of a market is really powerful. And one tenant that we actually just had as an example left a year or so ago, and we were able to fill it. We had about a month downtime, but we filled it with a company that we knew was in the market, and we had just connected the dots on it. We had to do a little bit of work in that month of overlap for when it was vacant, but we filled it really quickly. And I just don't know if I would have the confidence to do that in a market that I'm not actively in. It's just my strategy. I don't think it's necessarily right or wrong. I just think that it plays to the advantage of knowing your market that much better than anyone else.
Thank you. And so in those markets, the one you're invested in, so I assume it's in Alberta, in Canada. What do you see? What are the trends you observe in terms of transaction activity? And can you speak also to the transaction activity maybe in North America, if you're aware of those?
Yeah, and I think that actually dovetails onto the last comment quite well. Is that I do track that stuff all the time. We have a few data companies in our market that report on all the sales, and I'm sure it's similar in all markets. There's service providers that update whenever a transaction happens. So I watch every single industrial sale that happens and just figure out who the tenant was, what it sold for, what type of cap rate, try and get as much information as I can. I'm pretty diligent on that. I know every sale that happens in our market, and I just don't think I'd be able to do that in another market. I just don't think it's realistic for me to have that depth of knowledge on every market. So for my market specifically, I just want to make sure that any property that I get is kind of within that operating band on a few metrics. Like this will be pretty similar all across North America, is that cap rates are always going to be within a very tight operating band. You're going to see really good product in the 6% cap rate, and you'll see product that it perhaps needs some work on it in the 8.5 cap. In super hot markets like Vancouver in Canada and Los Angeles in New York, some of these port cities right now, they're seeing even further downward pressure on those cap rates. But for the most part, in like a balanced market, cap rates are in that 6 to 8.5%. So I just want to make sure that I'm buying responsibly so that I'm in there. If I can buy at a 6 cap and I can sell down the road at a 7 cap, there's a lot of upside there. Sorry, other way around. If I could buy at a 7 and sell at a 6%, I can make a pretty good spread on that. But it all just comes down to knowing where the market is going, what the trends are. And again, it really just goes back to fully understanding what type of industrial real estate it is. I don't want to beat that horse dead, but if you're comparing a manufacturing property that just sold at a 7 cap, but you're looking at a distribution company, it's a totally different asset class that you actually need to analyze on it. So I think it just comes down to having a really solid understanding of what type of property that you're looking at, and then making sure that you're comparing apples and apples on it, so that you're not trying to distort one property that is actually quite a bit different from another.
Thank you. And it feels like there is a lot of push for industrial investment right now. What would you say is driving that phenomenon?
The easiest answer is just upward demand. If you look at some of the big cities right now, Los Angeles has a 1.9% vacancy rate. New York is about a 3% vacancy rate. They're just really low vacancy rates right now, and part of it is the construction hasn't caught up to this increased demand. The timelines to build an industrial property can be anywhere from a year to 3 years, depending on when you secure land and go through the development permit process and then actually do construction. So there just hasn't been an increase in supply to match the increase in demand. And a lot of that is just e-commerce. I'm sure in everybody's market on this call, you've seen a massive distribution center go up in your market. In my market, Amazon 5 years ago had no physical real estate, and now they've got about 3 million square feet coming on the pipeline. And that's just one company. So if you look at all the different e-commerce companies that are trying to lease up distribution space, there's just a heightened demand for that type of product right now, and the inventory hasn't caught up. So that's what's driven vacancy rates really low. It's increased lease rates, and both of those lead to increased investor appetite.
Thank you. And do you think this is a fad or something that's meant to last and stay?
I don't think it's a fad. I mean, one thing that I try to be cognizant of is that I have no idea what's going to happen in the future. I mean, there could be any type of disruption that we're just not prepared for. So I try to temper all my comments with a bit of a grain of salt that I don't have a crystal ball. But if I were to guess, I think that e-commerce is going to continue to go. I think that traditional bricks and mortar retail is going to continue shifting towards that order online and have delivered model. So that's going to just come with an increased demand for industrial space, and then even smaller effects that I'm noticing is I think a lot of companies are just going to increase their amount of inventory. If you look last year, how a lot of companies just ran out of stock, and we're still seeing it to this day. There's still actually a lot of companies that just don't have any inventory. I think that there will be an increase in that warehouse capacity to just hold all of this stuff. So I'm physically invested in this. I am a betting man that I think that industrial is going to continue going at a steady pace for the foreseeable future.
Thank you. And so for those thinking about investing in the space, what are some tips you would give them to get started?
I think that the one thing that I would recommend is to actually do partnerships. That's served me very well from two main reasons. One is if you pool capital, you're just able to buy bigger property. The first industrial investment that I got was actually just a small industrial condo, and it was me and my partner that bought it, and it was a $400,000 condo. And I think we ended up putting about 100 grand into it. If you only take 100 grand, you're not going to be able to buy that much. Versus if you pool with a little bit more capital, you could buy a bigger property. So I think partnering with people just in opens you up to more opportunities just because you have more capital. And then the second thing is if you strategically pick who you're going to partner with, I think it helps cover your blind spots and also gives you more insight into what the property is and how you can think strategically. Because a lot of the times, if you're just making the decisions by yourself, you might overlook something or you might just become emotionally invested in either the tenant or the property itself. And without having somebody who's also financially invested in it making those comments, you might miss something. So I think it helps for those two reasons. It gives you more access to capital, and then you just have other people that are helping you along on that journey. And so a lot of people on this call are either brokers or have residential investment backgrounds. You could appreciate that if you were to partner with a commercial appraiser or a commercial mortgage broker or a contractor that specializes industrial, they're going to bring a different skill set than you would have not having that same background. So I think that'd be what I'd recommend to someone at the beginning is to look to strategically partner with someone that can bring capital and expertise.
Thank you. Yeah, very great advice. And is there something to look out for or to avoid? Would there be some overall recommendations you would have?
Yeah, the biggest thing that I would say on industrial real estate is to avoid properties that have functional obsolescence, and that's an appraisal term, but it's meant to describe things that aren't as an element of the building that isn't as functional as a modern building. And the most common example is ceiling heights. So a lot of the old industrial properties built in like the 70s and the 80s, they had 18 to 22-foot ceiling heights, whereas modern buildings are 32, 36, some cases they're 40 feet high. So I would just make sure that any building that you're looking at doesn't have any physical impediments that would be costly or potentially even impossible to rectify. So if you're looking at a property that is 18-foot ceiling heights and all the modern buildings have 32-foot clear ceiling heights, what does that mean for the future rentability or saleability of that property? So I think that that's the biggest thing that I'd recommend on industrial. And that's the biggest flag is just making sure that the building is going to be competitive with the rest of the market at some point down the road, whether you're looking to release it or sell it, making sure that that building is going to maintain its competitiveness.
Thank you. So we are done with the prepared questions, and I have two follow-up questions, but we're going to open up for our live audience here to if you want to put your questions in the chat, please do it. Do you have any tips? Because one of the value add strategies can be to purchase a building that has vacancy. Do you have tips on how to identify potential tenants, new tenants?
Yeah, I think it comes down to just having a good understanding of the market. If, if you're looking in Montreal as an example, you're going to know generally what type of industries are prevalent or who's going to be in the market. And you could also appreciate why it'd be harder for you to know what's happening in Edmonton because you're not in our market. So I think it really comes down to experience. It's there's not necessarily a list of tenants that are in the market right now, but it becomes very common knowledge when you're connected to the community. So as brokers, I mean that's one of the things that's an advantage to being a broker as an investor is you hear about a lot of these opportunities
Mm.
just by other brokers calling you and asking you what you have. So I don't know if there's a shortcut way to do it. Yeah, I think it really is work to do it. It's a necessary amount of work, but it's one that pays off if you're just willing to make calls, talk to brokers, talk to accountants, lawyers. They always have their ear to the ground on what's happening. If you've got a strong network of professionals that you just talk to on a daily basis, at least for me, that's where I get the majority of my market information.
Awesome.
Thank you.
I know in my market, in my specific firm as well, we've got a team of 5 or 6 folks that just focus on tenant representation. That's all they do.
Mhm.
So, another tip there: find a firm if you're unfamiliar. Find a firm that does that and just see what they need. See, because they're going to be getting calls. They're going to be doing exactly what you're saying and interacting in that community. And might be a little bit of a shortcut there to try to understand and they may have someone that's looking for exactly what you're looking at and get some information on the front side. So
Mhm.
good stuff there. We have one question that says, what size industrial assets do your partners tend to pursue, and do you prefer single tenant or multi?
Yeah, we've got both. We just bought a property last year in a sub market of our major market. So it's about 15 minutes outside of our major market. It's like an oil and gas sector. So it's a big oil and gas industrial park, and we bought a single tenant building in there. So roughly a 15,000 square foot building on 3 acres. We have a single tenant in there. It's a Fortune 1000 company. They've got 4 years or so left on the lease. So that one we had comfort with. We got it at a price we thought was fair. We got it at a price that we think even if they didn't stay in 4 years, that we could lease it at a fair rate. That one I was still even a little bit uneasy with because I really like the multi-tenant stuff. I think you're so much more diversified by staggering your lease dates so that you don't have the whole building come up vacant at one time. If you have your leases staggered, so you've got a lease coming up every 6 months, the pressure isn't the same as if the one building that we have in that small submarket, if that building came up, that's 100% of the cash flow. So that comes with a considerable amount of stress, and thankfully that's 4 years out from now, so I'll try not to think about it for a while. But I really like the multi-tenant industrial stuff, anywhere from 2,000 square feet to 6,000 square feet. I really like that product class.
Awesome.
Thank you. We have another questions from Jason. Do you have any strategies to value add on the ones you described as functionally obsolete buildings? We have lots of dirt, cheap, unused manufacturing space 90 minutes outside of Boston, huge buildings with no one to take the space.
Yeah, and that really just speaks to the risk of buying a property like that. Is it's very difficult to actually rectify those problems. There's companies out there that can physically raise the roof. It's a costly endeavor. So I haven't gone through it myself, but I know investors that have. I don't know if you're still going to get the corresponding lift and the value add proposition to it from the standpoint that you're just adding to the cost basis of your investment by making an investment like that. And I just don't know if you're going to get a lift. So to the people that own those properties, I'm sure that they're stressed about it because if they're getting zero revenue, but they still have all the overhead of running that building, I'm sure that that's a very stressful thing. And instead of myself personally, I don't have the risk profile that would look at that type of value add, because I just think that there's far too much risk, and the downside of having a building empty where you're still paying overhead on it. It's not something that I have an appetite for myself. But if someone thinks that there's demand for the property being uh, corrected, so if the ceiling height being the easy example, if there is demand for a property like that has a raised ceiling, then I think it just comes down to the economics. What can you buy the property for? What's it going to cost you to fix? What do you expect your lease rate to be on a pro forma? Run a quick IRR and NPV and figure out what your return is going to be. Then I think it's purely an economical decision, but I still think that carries a considerable amount of risk.
Yeah, for sure. For sure. Next question on there is, how did you find your deals?
Yeah, good question. Two of them we were brought by other brokers. So it just again comes down to word of mouth, that you tell people that you're looking to buy and you're an investment group. So I think having solid relationships with guys that sell properties is key. We get brought deals all the time. Like we look at deals weekly from guys that send us stuff, and I'm sure they're sending it to their whole list of potential investors. But two of those we had brought to us. Two of them we sourced ourselves by just whether it's clients that we had that we knew that they wanted to sell, or just a hearsay that you hear someone's going to sell. Two we sourced, two we had from brokers. Again, full circle. It would be very hard for us to have those same opportunities brought to us if we were in a different market.
Thank you. A few more questions from Darren, who seems. What percentage of ownership is mom and pop versus institutional money?
In terms of how much they'll finance.
No, I think he means in terms of market shares. What's mom and pop versus institutional?
Yeah, that's a really good question. I suspect that it's actually very similar in most markets, and I think you could also delineate it based on size. Like if you're looking at any investment over $10 million, the majority of that's going to be institutional. Like I would say you're probably 80% institutional, and then the balance might be family money or generational ownership. It's not common to see many private investors over that 10 million range. It still does happen. Even in our market, we've got one family that owns 4 or 5 million square feet. And that's not an institutional company. That's just a local family. So it does happen. There are some wealthy investors, but the vast majority of ownership over $10 million is going to be institutional. And then it starts getting watered down. Like the building that we actually bought, that we're just doing a full renovation on, we actually bought that from a big pension fund, and that we bought that for $3 million. That was one of their smaller properties. So you do still see those institutional investors sub $10 million, but most of them are going to be chasing up 10 million, 50 million, $100 million properties. So I would say it's a lot harder to compete in that over $10 million range as just individual investors. Once you get under 10 million, it's wide open.
Thank you. Logan, you want to take on the next one?
Sure. So the kind of going right along this one is a financing question. Is there any Fannie Freddie money available for these loans, or just working with local banks?
Yeah, I have no idea. It wouldn't hurt to inquire on it, but everything that I've done has just been local banks. I mean, you can start being more aggressive and even look at alternative lenders and look at the non-traditional banks for capital, but you're always going to be paying a higher rate. So if you can get 5-year money right now at 3% or less, and you're going to a private or secondary lender, you're probably still paying 6 to 8%. And then the higher the leverage you go, then you're paying even more. So it's nothing that I've pursued myself. I like having equity in there because I think it's a natural hedge for risk, just having a buffer in there. And then it also just helps with cash flow. The higher leverage you go and the higher interest rate you go, the more you're eroding into your cash flow. So I mean that's a whole topic in itself. But I think cash flow is imperative. I think you need to have cash flow in a property. And as soon as you start looking at higher leverage or higher interest rates, you start eroding that cash flow. But to the Freddie Mae and Fannie Mae, I don't know. I would talk to bankers, talk to mortgage brokers, and see what their thoughts on it are.
Mm-hmm. Yeah. And are your properties, this one's about the leases, are all your properties triple net leases?
Yes. And I wouldn't say that that's necessity, because as long as you've got language in your lease that you can increase the operating cost to the tenants, how the language actually works is just a bit of a nuance in terms of the contract. But I think whether it's structured as a triple net lease or whether there's a provision in there that you can pass through expenses to the tenant, it's achieving the same result in the end. But I would never buy a property that was a fixed gross rate where I had to eat any increases in property taxes or overhead. That'd be a no fly for me. I would need to know that I can pass through any expenses to the tenant.
Mm-hmm. Yeah.
Thank you. In the 2,000 to 6,000 square feet you mentioned for multi-tenant buildings, what kind of amenities, leases, etc., do you find are most attractive to tenants? What kind of businesses are renting that size industrial space, and where do you find them?
Yeah, great question. There's a lot there. So what I look for, if you're in that 2,000 to 6,000 square foot range, you're probably not going to be getting big warehouse space or big distribution space. The properties that I have are kind of either manufacturing or flex, so they can kind of accommodate a lot of different uses. And I've got various tenants. I've got a hot tub company. I've got a company that makes cabinets. In one of our industrial buildings, we actually just put in a flower store. I've got an oil and gas tenant. So we've got like a pretty wide mix of tenants in there. I think what it ultimately comes down to is knowing that your building is just going to be competitive with everything out there, and be creative. Like you might occasionally just come across bizarre tenants. One tenant we had, which left, and we ended up replacing them, was a kitchen equipment repair company. So the guy it was a 2,500 square foot bay, and the entire thing was just stocked with leftover kitchen equipment, and it was packed literally to the rafters of junk. But he paid his rent every single month. We never had to chase him. We had a check on our desk first of every month. He was an awesome tenant. We never would have thought that a kitchen equipment repair company would have been the tenant that we had in there. So I think instead of trying to find one specific tenant for it, I like to take the approach that I want to market it to everybody, and then I get to pick who the best one is. And maybe it's the only one. Maybe only one tenant inquires, and it's a kitchen equipment repair company, and that's the one that you have to take because it's the only tenant there. But if you're properly marketing it, whether you're doing it through a broker or whether you're trying to do it yourself, I like taking the approach that market it as wide of a net as you can possibly cast, and see who comes, and then find the tenant that you think will be the best fit for the building, has the best credit, best intentions for staying there long term, and then make a decision on who comes, as opposed to necessarily being fixated on finding any one type of tenant in particular. So I don't know if that answers the question or not, but I guess that's how I always approach any vacancy that I have.
Mm-hmm. Oh, that's great.
Thank you.
That's awesome. I think it seems like most people on the call who are not familiar with industrial or who want to become familiar with industrial, the biggest fear is not knowing that tenant. We all know that when you have a house and it looks ugly and you paint it and you put a new kitchen in, you put a bathroom in and make the outside look nice, that now more people are going to want to rent this place. But I think if you've not done it before and you've not been there, it's a little bit nerve wracking about where you're going to find those folks. And so I think to your point earlier, if you don't know, if you have cash and you want to invest in industrial, and if you don't know how to do it, find someone that does and invest with them and partner with them and go at it that way. Maybe you can be the financing and learn it along the way with them, or find a mentor. We were talking about mentorship earlier. I think that's a phenomenal way to go about it.
Yeah, it might sound a bit peculiar considering I'm a broker myself, but I generally tell new investors that it should be scary. Like I think industrial real estate should scare people when they're first getting into it, because if you do make a mistake in industrial real estate, it can be very costly. I think that there's tremendous upside. I believe in it wholeheartedly. I think it's a great asset class to have. But if you make a mistake at the beginning, it can be very costly. So I think people should be scared. I think that there's like a healthy amount of fear that people should have, and there's steps you can do to minimize that. I think that the worst thing that fear can do is if you don't recognize that there should be fear and you just go into it guns blazing. That's kind of like fear leading to stupidity. But if you recognize that you should be afraid and you take steps to mitigate that risk, then I think you're actually making a really prudent decision. And to do that, I think you just have a really deep understanding of the knowledge of the industry, of the market, what vacancy rates are, what prices are trading for, making sure that you're hedging your downside risk, and then also just having that solid understanding of what that property is worth, even if there isn't a tenant. I think that's like the biggest tip that I would give somebody is the cash flow is great, but that tenant won't stay there forever. It's just things happen. Tenant might move, they might go bankrupt. It happens all the time. So you might make your decision based on that cash flow at the beginning, but even more important than that, have a solid understanding of what happens if and when that tenant leaves, and know that your downside risk is at least protected by some amount. Then I think you're starting to get into that realm of making a really smart decision. So it goes from that really scary proposition at the beginning of just not knowing what the tenant is or what the market is. If you have a solid understanding of what industrial real estate is, that what category of property that you understand all the strengths and really big weaknesses that might be potentially in that property, and then have some availability of understanding what the future leasability or saleability of that is, you can make a really good investment in this. Like it can be a really solid, stable investment over the long run. But you need to understand what the property is and what that property will be when that tenant leaves.
Awesome. Awesome. I think we have one more question. When you underwrite a submarket before you buy an asset, what are the three most critical factors you're looking at? Maybe there's three, maybe there's two, but what are the most critical factors when you're underwriting an asset and looking at that submarket?
Yeah, a very similar process with that one property that I mentioned that we bought in that submarket. It's a single tenant building. So when I was doing my underwriting process, and we have debt on that one. We bought that one for 3.1 million as well, and we put down about $1 million on that one. So the bank did a considerable amount of underwriting, so we had to do full appraisal, full environmental report, full building condition assessment. So we did like all the traditional things that you'd go through the process to finance it. But in addition to that, how I looked at it internally was 4 years out when that tenant comes up, and we hope that they stay. That would be ideal if they stayed. But what happens to that property in 4 years? And for me, I know the submarket reasonably well. So I just have a pretty good idea of what all the vacancies are in today's market, and how I looked at that is if that tenant were to leave, it's a Fortune 1000 company, so I don't think they're going to default. But if they did go bankrupt for whatever reason, or if we had to take that property back in 4 years, what do I think that will lease at? And I was comfortable enough with that decision to go forward on that basis. But I think it just really comes down to having a good understanding of what the property is, and how competitive it is with similar type properties. One thing to piggyback on that as well is to even understand what new product can be built at. Because even if you look at the existing amount of inventory right now, properties can always be built too. So in submarkets, in the one that we have is a good example, there's a ton of land all the way around it. So if somebody wanted to, they could conceivably buy a piece of a 3-acre parcel of industrial land and build something. So we need to have a pretty good understanding that our cost per square foot on that building itself was also at a number where we had some built-in comfort. And as it turned out, we figured it would cost $50 a square foot, give or take, more to build something new. So we looked at it that we think as long as the market doesn't change significantly, we'll be able to lease that out for a comparable rate. And if we decided to sell it, people looking to build would have to pay considerably more than buying an existing building. So those would be the main things that I'm looking into, is just how competitive is that from a lease rate? What do I have to compete with if someone can build? If someone can build cheaper than what it costs for the existing building, all things being equal, they're probably going to build. So having a pretty good confidence on that is important as well. But those, in addition to all the things that we had to do for underwriting with the bank, those are kind of the thought process that I go through internally.
Thank you. Um, Another question. What are your thoughts on specialized industrial buildings such as crane equipped or with outside land storage with tenants in place?
I love buildings that have extra amenities like that. Cranes is a perfect example. If you have an overhead crane, it's already in the building. That's a huge advantage for tenants that need crane. And if they don't need crane, it's still a service that you could have for future tenants down the road. Cranes are a bit more complicated because you actually have to get them certified regularly, and that's costly to do, and you have to do a lot of maintenance on them. So if you have an inactive crane, it can be almost become a bit of a liability during a lease if a tenant's not using it. But most tenants are going to have some use for crane if they're on the manufacturing side. So I really like buildings with cranes, but it all comes down to what you have to pay for it. I think that just becomes an economic decision. If you have to pay an extra $100,000 to buy a building that has a $100,000 crane, I don't know if you're necessarily getting a lift on it. But if you're buying a building and the crane is just a free add-on, then I think it's an absolute no-brainer. But it all comes down to what the market wants. If you're in a market where tenants don't need cranes, then there's probably no reason to have it. Whereas if you're in a market where cranes are an expectation of tenants and your building doesn't have a crane, that's probably something you're going to have to add.
Thank you. So we don't have any more questions. I have a question. So I've discovered you through social media. Logan posted a video, a YouTube video of you on our Facebook group. So can you tell us why you do social media and what are the benefits for you?
Yeah, well, thanks for that. And I'm glad that I was able to connect with you and Logan on that. So I started it about 6 months ago, right in the middle of COVID. I just had some more time on my hands. And as you could tell, I love industrial real estate. Like I look at it not just as my profession, but as like a nerd level hobby. I don't know if you could see all the books behind me, but I've read pretty much every book imaginable on industrial real estate, architecture, even going back to like the history of the Industrial Revolution. I've got like a nerd level fascination with industrial real estate. And I remember when I first started 15 years ago, there wasn't a lot of information available. I tried finding books, I tried finding videos on it, and there just wasn't a lot of info. So I just figured I had some extra time during COVID. It's something that I love doing. It's kind of like it's a profession and a hobby for me. So I just thought I'd start making some videos on YouTube, and I don't know where I'll go. It could be one of those things where I just fade out because there's not enough interest in it. But I figure if there's people out there that I can help learn about the industry, and it's something I love talking about anyways, then could be kind of a win-win situation.
Absolutely. I think you mentioned earlier, that credibility that you had with those people that knew you and knew your profession and knew your career coming up through. I think that social media presence you're building is a way for you to kind of show that to the world as opposed to just your local community. So you never know where it leads. Like you said, you don't like the syndication model or the fund. I'm not sure which one you did, but you didn't like that model. But in the future, if you need to and you want to advertise, I mean, you're building a platform that anybody that watches your stuff is just going to instantly know what you're doing. So it's impressive stuff. We're happy to have you.
I appreciate that. And the way I look at it is, as of right now, the best thing that's come from it is actually just getting to connect with guys like you. That's been my favorite part of it by far so far.
Sweet. That's awesome.
Thank you.
That's awesome. Well, we're happy you're here. I think we're going to move now on to our networking. Like I said, you're more than welcome to hang around and chat with folks if you want to get to know people a little bit better. Typically what we do is we do breakout rooms, so it's a little bit smaller, and then everybody can just kind of get to know each other. But thank you so much. Thank you for coming on. This was a phenomenal interview. I know everybody learned a ton. I learned from you. Every video I watch, I learn something every time. So it's phenomenal. Really, really appreciate you coming on board, and we're definitely going to keep in touch for sure.
Yeah, absolutely. Well, thanks again so much for having me on. I'd love to stick around for a bit too. And thanks again. Really do appreciate that. And you guys have an awesome thing going here too. I love it.
Thank you. Thank you. If you want to, how do people get a hold of you on those social channels, or how can people get in touch with you?
Yeah, so I'm pretty active on LinkedIn and YouTube. That's probably the two main things. I think if you just search anything industrial real estate on YouTube, I'm really the only guy talking about it on a
Yeah.
regular basis. So you'll probably see my name come up. And if you want to email me, my email is griffithscre@gmail.com, and I'd be happy to chat with anyone if they have any questions as well.
I'm going to type that in the chat and tell me if I got that wrong. So griffithscre@gmail.com.
Yep, nailed it.
Cool. All right. Awesome. Well, thank you.